Thank you, everyone, for joining us this afternoon for our webinar on Know Your Break Even so you don't break the bank. Today we have Vicki Newton and Jeanette Schwartz. Ladies, it's all yours.
Thanks. Vicki, you want to introduce yourself and take it away, or should I go first?
Go ahead.
Hi, so my name is Jeanette Schwartz-Rattan. I'm Director of Marketing here at Out of the Box. I helped Vicki put her presentation together, so I'm just going to be helping her out a little bit throughout today. If you need to get in contact with us, please feel free to chat questions to us in the Q&A box, and we'll answer those as we have time. I believe we've saved about 10 minutes towards the end too. So Vicki, you wanna take it away?
Sure. Well, hello and good morning, everyone. I'm Vicki Newton, and I'm an executive director here at Out of the Box Technology. I have been with this company for about 6.5 years, and I've been doing accounting for about 42. So I know the world of accounting, and hopefully this will be really easy and simple for everyone to understand today. And then I'll be available for questions, obviously, at the end and even after the meeting. So let's go ahead and go to the next. Well, there just shows my picture and what I've been doing. And I'm a pro advisor, certified pro advisor with everything in advance. So go ahead. In here you have, I don't even know what this subject matter, we're talking about QuickBooks, we're a solution provider, we're elite pro advisors. I think this is just solidifying what our company offers as far as the Intuit products and our expertise. Okay, so what we're doing today is we're talking about streamlining accounting process for businesses. That's a goal, and providing business owners with valuable and operational reporting tools. One of the things I find when working with a lot of new business owners, even with people who have been doing it a long time, that they really don't have a clear picture of how to read their reports and how to understand what they need to do to make money and to break even. And so that's what we're going to be going over today, is the things you want to look for in being able to really manage your business financially. Go ahead. So there's 3 questions every business owner asks. And the first one is always, the first, but if you don't have good bookkeeping, these numbers aren't going to mean anything because they're not going to be true. So the first one is, how much money did I make? What did I make last month? Well, if things aren't being recorded correctly, that number isn't going to be accurate. And then where is my money? The money that I've got coming in, going out, where is that going to? Again, it's all about good bookkeeping. How much will I owe in taxes? Now, this last part is something that generally gets coordinated with your CPA, whoever files your taxes, because what they generally do is, especially if you're paying estimated taxes, they're looking at your reports to go, okay, this is how much they're making, this is what they're projected to make, this is approximately what I think they should pay in estimated taxes. If you don't have accurate accounting, you can either be extremely underpaid on your estimates, or maybe even extremely overpaid. So that's another reason why you've got to have really good bookkeeping. Go ahead to the next. So there's 2 different things that a lot of people don't understand the difference. So we're just going to talk about that briefly. So we have bookkeeping, which is, basically organizing, recording, posting, summarizing all the information in systematic processes to get, invoices, checks, bills, all those things. That's bookkeeping, getting all that information in your system. So then the accounting part of it is being able to analyze and interpret everything that has been put into your data file, and being able to look at that and understand what it means. And the break-even analysis that we're talking about today relies on both of those things, being able to look at those things. Okay. So the importance of having solid bookkeeping practices, or someone that knows what they're doing your books for you. And you need to make sure that you can you're required. This is something I try to explain to people all the time. Just because you have an internal bookkeeper doesn't mean that they're doing the right job. So I always suggest that everyone they be required to provide their financial statements to someone who's outside of the organization, an outside advisor, an outside coach. I do a lot of reviews for companies that have people that do their stuff, or they do their stuff, but they come to me sometimes monthly, sometimes quarterly, sometimes once a year, just depends on their need. But they come and say, make sure, go and look at this. I do a deep dive and I look at everything so that I can point out anything that looks like it's an error, or it needs to be fixed, it needs to be reconciled, it needs to be corrected. And a lot of times when I'm working with a company to start with, this is something that we want to do every month until they get the hang of it. And generally, once you start doing that every month, and then you start seeing, okay, it's looking good every month, then you change it to quarterly. But I always recommend that before you ever send your information to a CPA for tax returns, that you have someone review your books. Because a lot of times people just send it and they're wrong, and then your taxes are wrong. So it's we offer different types of services for monthly consulting, monthly coaching, monthly reviewing, that you can get discounts if you sign up for different levels. So those things are all information that we can get you from our business development department. It protects your investment. A lot of people put their money in, and it might be their life savings. And if you aren't doing a good job, you can lose everything. So you want to do the best thing you can. It's people say, oh, I can't afford that. Well, you can't afford not to. I'll tell you that, because we do a lot of cleanup projects for people that cost them thousands and thousands of dollars because they've done horrible bookkeeping for the last 3 years. It's just something that we see all the time. So I'm always encouraging people, invest a little bit to protect yourself, make sure you know what you got. It provides the information to sell your business if you're looking to sell. I have people that are looking to open a second location, possibly franchise, or even sometimes you've got to have this information correct. If you're trying to get an SBA loan or a bank loan, they want accurate financials. So, and then of course, the last thing is that we want this accurate because you want your tax returns to be correct. Go ahead. So there's 2 different types of accounting methods. And I ask people this sometimes, are you on cash or accrual? And they don't really understand it. So we're going to talk about this for briefly. And then it's something that I'm trying to get people more educated about, because it does make a difference. So when you are a cash method reporting, what that means is that you file your taxes based on a cash, and it's usually something you have to let the IRS know what if you're filing cash or accrual, and it's usually on the bank, the tax return itself. So when it's cash, you're only, and let me say this too, the QuickBooks system allows you to run reports on both bases. So it's nice because the cash is going to give you revenue and expenses that are only when you've been paid on. So for example, on a cash method, if you sell someone a service for $50,000, but they haven't paid you yet, you're not going to have to recognize that as revenue until you actually get paid for that. So for some people, that's a big difference. And if they have a lot of things that are sitting at the end of the year that are unpaid receivables, they don't necessarily want to pay taxes on stuff they've never even been paid on yet. So a lot of people choose to be cash. Now, the accrual part of it is that revenue, expenses all get recognized when they're put in the system. So if you're putting in 15 invoices, whether they're paid or not, that all becomes part of your revenue. Expenses, you put in all your bills, those things are going to be recognized whether they're paid to the vendor or not. So what it says there, he just talks about, it's when the money actually changes hands. And that's the difference. Usually your CPAs can tell you what they think you should do, but it's something to think about when you're, especially when you're starting something new. Some places, I don't know if certain franchises have requirements of how you have to report, but most individually owned businesses do get a choice of how they want to report, but it's not something you can just change randomly all the time. You have to pick one and then stick with it, and then you can make a change at some point, but it has to be filed that you're changing your method of reporting. Next slide, please. Okay, so reporting on the financial condition of the business, you have an income statement and a balance sheet. I get a lot of people saying, well, what's the difference? I don't understand. How come it's not on my balance sheet? How come this is on the, they don't really get the differences. So we're going to talk about that for a minute. So when you're looking at your break even, it's going to focus on your income statement, because your income statement is what reports all of your revenue, everything that you provide services for, what you sell, all the things that you're getting revenue for. And then all the expenses that are associated with providing those services or those products. And in addition, all your fixed expenses over a monthly basis, quarterly basis. Most people, you have the option of running monthly, and I would recommend everyone run monthly statements to stay on top of things. But that's what the income statement reports. So now at the bottom of your income statement, and you're going to see one here in a minute, there's always a net profit or loss. That number is what carries over to the balance sheet, because the balance sheet is what shows the financial picture of your company. So it shows everything that's an asset, any money that you owe people, liabilities, which is going to be either, vendors or loans, payroll liabilities, those type of things. And then the owner's equity. And the owner's equity can be money that was put in by the owners to start things, their percent of ownership that gets distributed if there's more than one out of the retained earnings. And also then the income that carries over from the income statement is included in that equity. And so the two together give you those are the two that everyone looks at to look at the financial condition of their company. But people have to understand this is the difference between the two. And I do a lot of training on educating business owners how to understand that. But make sure the focus from the income statement is determining what you need to do to break even. Next slide, please. So the income statement, there's a general rule, and people, this is something we learn in accounting. It's like income minus expenses equals profit. Well, that's pretty easy, right? That's pretty simple. It's pretty revenue earned from selling goods and services, the costs associated with the generation of revenue. That's where you end up with your profit. And so that's a pretty standard, formula, pretty simple. Let's go to the next slide. So on here, what it's showing you is the break-even point and how that's determined. So if you look at this chart, it's giving you a 5-year thing here. So we're looking at, say, year one, and usually year 1 and 2 are usually tough for new companies, but some of them start off at the bang. It just depends on what kind of business it is and what kind of expenses you have. But what it's showing you here is that the orange is the income that they took in. The blue is the expenses. So you can see in the first 2 years, the expenses outweighed the income. So they actually lost money, and it went below that 0 threshold of break even. But then in year 3, 4, and 5, they actually increased their income, and their expenses, fluctuated a little bit. But now that gray bar is showing that they're actually making money. So that 0 line there is what we're always looking to make sure we're at least breaking even. A lot of companies don't, and some companies have seasonal profit and loss. They might have certain months of the year where they make a lot of money and other months where they don't. So sometimes they only look at their overall year, because they know that, each month is going to be different based on, landscaping businesses are like that a lot. They have a lot of stuff that, certain times of the year, there won't be any income, but other times there's a ton. But this kind of shows you how that works in the net income and loss world to get that 0 net income. Go ahead, next. So this is a profit and loss statement, an income statement. This is just a general format of what it looks like. The good thing with QuickBooks is that we can customize a lot of this based on your needs. If you want to have a lot of different income accounts, if you want header accounts and expenses, so you can look at sub accounts, but this is a general one that just shows you, hey, this company took in 347,000 in income, and then all the expenses were 222. So they had a net income of 124,000. Pretty self-explanatory. But if you're doing a really good job, you're looking at everything. You're going to look at the details of what went into each account. That's why I say some people, when it comes to say, what's one of them we can talk about? Automobile expense. Now, I have a lot of clients that may have several automobiles, but they want to track not just automobile expense. They want to look at repairs and maintenance, how much they spent for gas, how much they spent for insurance. So you create sub accounts. So there's ways you can detail this out to show you more than what just the basic accounts show. Utilities is the same way, showing, garbage versus water versus whatever, wages, showing, salaries versus hourly versus payroll taxes versus benefits. So, but this is, again, this is just a general profit and loss statement. And this one's showing for a whole year, but you can break in, and within QuickBooks, it's nice because you can break it out by month, you can break it out by quarter, you can break it out by year, you can compare it to a previous year, and there's more information we can provide that you'll see on the a couple slides later. Jeanette, do we want to take a look at chat and see if there's anything we should answer right now, or?
I'm looking in there now. It doesn't look like we've received any questions as yet.
Okay, just want to make sure. Okay, next slide. Just let me know. Okay.
Will do.
Okay, so the balance sheet. So the most important financial statement, but least understood by business owners and bookkeepers, is the balance sheet. Because this is the, like I said before, assets minus liabilities equals owner's equity. Can this slide go down a little bit? I think there's something below there maybe. No?
Well,
No?
there's
that the
nothing.
bottom?
Yeah, that should be the bottom.
Okay. So again, when I talked about this earlier, the balance sheet, that tells you the financial picture of your company, not the details of what you're making profit and loss wise, but where you sit with your assets, liabilities, and your equity. And this is what's going to show you, hey, we're upside down. I have some clients that are individual business owners, and they take draws. Some partners that take draws. Well, when you take draws from a company, it decreases your equity. So what I tell them when they're looking at things is continue to watch that, because if you're taking more out in draws than you have equity in the company, you're hurting yourself. So there's ways that I show people how to read those things so they can stay on top of that. I had one guy's like, you've only made this much money, but you've taken out twice that much. So you're just depleting your cash, and it doesn't necessarily change the P&L part of it, but it changes the equity. And that becomes an issue when you're trying to get loans or trying to maybe sell or in those type of situations. Go ahead to the next slide, please. Did you see that question?
I'm sorry. Patrick's asking, don't we have to take salary though?
It depends. Some corporate structures don't allow you to take a salary. You have to take draws. You can take salary, but that's not going to go, again, it's equity. It's going to be up in your P&L. It just depends on the financial structure of the business. When you're, because you generally have, and it goes over this a little bit later, but we talk about, single owner, sole ownerships, partnerships, and then corporate. And there's different levels that say, okay, well, yes, he can pay himself a salary out of this level, but he can't here. He has to take draws. So the draws usually, some people will put them up in their P&L just so it shows that part. Yeah, so Trevor is saying that he has an S Corp and he pays himself as an employee on payroll, and that's perfectly fine. It's usually the sole proprietorships and the partnerships where they have to do draws. So go ahead to the next. Oh, wait, where did I? Yeah. Things of value under the business. Hey, okay. So the liabilities, now those are going to go, those are amounts owed to outsiders, like we talked about, loans, people who have car loans, equipment loans, business loans, and then also liabilities that you're required to pay as part of For example, if you're paying payroll, you've got payroll liabilities. If you're taking 401k out, if you're withholding child support, those are all liabilities. So they show on the balance sheet as something that you owe. And it talks about there, it's like credit cards, loans, and different things. So it's always just remember that if you owe somebody, it's a liability. If somebody owes you, it's an asset. Go ahead, go to the next slide. So in the balance sheet, the equity, like we talked about earlier, the value of the company is determined largely by the equity balance. So if you are trying to sell or get a partner or something, it's going to show you the equity is the excess of assets over liabilities. So you can kind of see in this chart how it shows, the assets and the liabilities, and then how the equity can drop below what the value of the company is. So in that second quarter, it did, because there were more liabilities than there were assets. So it just adjusted that equity down. And that's usually as a result of maybe a lot more expenses that month and less revenue. But it fluctuates every month. And so that's something like I said earlier, you want to keep an eye on. So the owner's equity or net worth is when you have the assets minus your liabilities, and that's what becomes the equity of the company. So.
Hey,
Go ahead.
Vicky, Patrick was asking about owners in an LLC and how they should pay themselves.
With LLCs, trying to remember. I think it's draws, but see, I'm not a CPA, so there's certain things that I have to look up sometimes because I'm trying to remember. I think LLCs are draws, because I know that a lot of the stuff I do for people that have partners, or they all take draws, they don't take salaries. I think it just depends on the structure again, but we could, we could look at what you have, and usually we say, talk to your CPA, because they're going to let you know for sure, if you can go ahead and pay yourself a salary. Some people pay themselves a salary and then take distributions out of the company as well, if they're in ownership. Go to the next one. So again, balance sheet shows sole proprietorship owned by one individual, partnership owned by two or more individuals, corporation organized under state or federal law as a separate legal entity. So the partnership one, and this is what I tell people a lot, is if you have partners, make sure that you're reflecting that on your equity section so that you can actually see each individual partnership's activities. So if I have a partnership that's 50-50, I will create a equity account, contributions, equity/contributions, and then I will also create a distribution account or a draw account. And then, because then when you look at the balance sheet, you can actually see what each partner has done. In some situations, it's required, if there's a 50-50 ownership, that those two amounts are equal. And if they don't stay equal, then there's an issue. So that's why I always say, show those separately on your balance sheet, because sometimes now I've had companies that have 12 different partners. Well, it's kind of hard to determine what has what if you have it all under one particular account, if you're married to your partner. If you're married to your partner and that's your only partner, and you guys file, if it's a pass through to your personal account, it probably doesn't matter if you file jointly. So in those situations, you're generally okay to keep it under one. Hope that answers your question. Go ahead. Okay. So in here, the balance sheet, sorry about the dogs background. So when it talks about this, do the math for the assets, it's really easy. The rule is assets minus liability. Owner's equity. Hold on one second. Guys.
Stop it. Drop it.
I might have to take Peanut in the bedroom.
Peanut.
I apologize for that, guys. I have a guest dog here today with my dog, and they're kind of being selfish over the toys. Anyway, so, okay, yeah. So the rule is assets minus liabilities equals owner's equity. So let's go ahead and go to the next slide.
No, Rocky, no.
So, but
Well,
what? Go back.
Lay down.
The rule restated like this: assets equals liabilities plus owner's equity. So when you look at a balance sheet, it's going to show you here in a minute why you look at it more that way as a rule. Go ahead.
Beat us, stop.
Okay, so here's your balance sheet. So if you look at this, it's going to show your assets. It shows all your current assets, which is usually all your bank accounts, accounts receivable, your inventories. And then you go down to fixed assets.
No.
Just 1 second. Stop it. Stop it. We'll go put you in the bedroom and shut the door. Okay. And those all, and your accumulated depreciation, your fixed assets, which are, cars, trucks, big office equipment, those type of things. So that's your total asset number. So then when you go down to the bottom part of the balance sheet, all the things you owe there, your payables, your credit cards, retainers, lines of credit, loans, those are your current liabilities and your total liabilities. Then the equity section. So when you add those liabilities to the total equity, that's what equals, you can see there where the numbers are always the same. And they should never come out different. They will always come out the same. The only time I ever see that as sometimes there's a difference is usually on desktop version because of a rounding situation, but the system creates this report automatically. So it's not like you have to try to balance it yourself. Back in the old days when we did things by hand, yeah, that was a little more tricky because sometimes we had to really go back and try to figure out why it wasn't balancing. What was that question that he just had?
Trevor's asking, what would employees with income generation potential fall under? For example, if you have 5 techs that bring in 1,200 to 100, I'm not sure what he's 12 to 1,500 per day.
Well, your technicians are not going to be part of your balance sheet. That's not even a relevant thing on here. What that's going to be is, and I think we go to the P&L in a minute on the next slide, but generally you're going to show the revenue that they bring in and then the cost of their labor, which you pay them in labor and benefits is shows as a cost of goods sold on the P&L. And that isn't reflected anywhere here. It's just going to be reflected in the total P&L statement that goes here on the bottom part where the net income transfers to the balance sheet. Got it? So COGS, yes. Okay, next one. So here where you see the temporary versus permanent, you can kind of see the difference here. So on the left, you've got the profit and loss, which is what we talked about, your income versus less all your expenses. And then on the right, you have the balance sheet. So you see how the number on the bottom of the profit and loss carries over to the balance sheet. And that becomes inclusive in the equity of the company. Now, what I talked about earlier, you can see there where this particular example shows that there's 2 partners. So you've got 2 partners with equal amounts of capital and equal amounts of draws, and that's the way it's supposed to be. But if you're doing it right, that's the way it should stay. But some people forget about that. And one partner will say, oh, I need to get a $5,000 draw. Well, if that one partner gets one, then the other one has to take one too. So they have to be equal. So it kind of shows you how one carries over to the other. The right side is your permanent financial position. The left side is a temporary. Next slide, please.
I'm just going to go to this. Whoops, my screen sharing stopped. Give me 1 second here. I was going to go to a different view because some of the attendees said they had trouble seeing the bottom of the slide.
Oh, yeah, okay.
So just wanted to give you a little overview here.
Okay, are we on the next? Is that the next one?
Yep.
Okay. So within QuickBooks and financial management, obviously every industry is different. So there's unique processes, unique platforms. that give you the best software to provide the most accurate and efficient bookkeeping for your business. We have businesses that are service-based only. We have businesses that are construction, so they have a lot of cost. There's job costing. It just depends on the type of business you have. And you usually, when you're setting up your QuickBooks, you can choose, that'll say what type of business is it, and then it'll pick like a particular chart of accounts, different things that you can obviously customize, but it gives you a what you want to call maybe a template. But then based on your industry, we can set up things that are, you know, unique to your company even, but that we're making sure that whatever we're doing within your QuickBooks is giving you the best numbers to look at possible. Go ahead. So every business owner will say, well, how much, or maybe they don't, some of them don't, I've seen, but how much do I need to sell? How much income do I need to generate to cover my expenses? At least so I can, you know, so I can break even, right? You're break even. Because the worst thing you want to do is lose. But, you know, a lot of companies, they're just striving to break even the first couple of years to be able to pay their expenses, pay their salaries and payroll taxes and those things. They're not looking to, you know, everybody wants to make profit right off the bat. But if you're a business owner and you've looked into it, you know that most companies don't make money their first 2 years. But it just depends how good you stay on top of things. Go ahead to the next slide. So the break-even point, what is that? It's a point at which your fixed costs are covered and the business shows neither a profit or loss. And it's expressed as a total amount of sales. So when we're looking at the reports, there's ways we can run that kind of show how we can kind of calculate where I need to be able to even break even based on my cost. Next slide, please. So knowing that is really important because you really need to know how much you need to sell. Is it really feasible that based on your cost and maybe even your own salary that you can sell enough to cover those things? Are you just inadvertently starting a losing effort? And what are you going to, you know, what do I have to do to get to that point? So when you don't know your break even, again, it can result in losses, negative cash flow, and breaking your bank, putting you out of business if you keep on doing that, you know, and you don't want to have to keep putting in personal money. A lot of people will do that, but that's because they haven't been paying attention. And they'll just say, oh, I need more money to do this. Well, why? Let's take a look at why. What's the reason that this is not happening the way that it should? Is the required sales volume realistic? That's what I'm talking about. If I know I'm only going to sell this total dollars of sales, if that's all I'm capable of doing, then I have to be able to justify the expenses and the cost of goods sold to see if I'm even going to make money. Sometimes, you know, they always say you got to spend money to make money. You know, if you're a service-based industry and you have, say, three people that provide services for you, but they have a certain amount of time in their week and a certain amount of hours that they can do. And this is something we do with our own company internally as well. You know, if one of our project managers, you know, has 80 or 40 hours a week and we expect them to be billable for 35 of it, are they going to be able to bill enough hours to cover their salary and cover the expenses associated with them so that we're not losing money? So it's something that you are looking at, and there's ways to calculate those things. Are you marketing things enough? Are you, you know, how are you looking at how you're going to either increase enough to cover your expenses or look at your expenses to reduce the overall total expenses? Because some people get crazy and, you know, they think, oh, I'm just going to throw all my personal meals in here and see what I can get away with. But, you know, it depends on how if you need to present financials to other people, you know, you got to be careful about those type of things that you do. Go ahead to the next one. So what information do you need to calculate your break-even point? First, you got to, you know, we separate the fixed from the variable. Fixed costs, people don't always understand this as a big accounting term that, you know, but the fixed costs are stuff that generally stay the same. Your, you know, monthly cable bill, your monthly, you know, bookkeeping bill, your monthly utility bills are generally going to stay pretty consistent, but those are things that rent, overhead costs, management salaries, those things are going to be consistent regardless of how much you sell or not. So those are what they consider fixed cost, because you can't do a whole lot to change those except just cut out the expense itself. The variable costs are costs that are proportionate in total dollar amount to the level of sales activity. So if you are selling $500,000 worth of revenue, but your variable cost are, 300,000, there's a percent there. And you have to make sure that you're charging enough to cover the costs that that you create to be able to provide those services. So if you've got I've got some consulting or therapy companies, and you pay a therapist this much money. Well, if that therapist is being paid this much, then they've got to generate this much in what they bill out to cover that cost, or else you're going to lose money. And so it just kind of rolls with all of that: material cost, direct labor, those type of things, but they're variable because they go up and down. These things here are stuff that you can control to some point, but a lot of times it's based on how much you actually do. So if you're doing a construction project, hey, we got a goal to keep our material costs at least at, 15% or whatever. Those are numbers you can look at, because when you start those numbers rising up and cutting into your gross profit, that's when you're going to start losing money. So it's very important. And I just think a lot of people, I can't press this enough, don't pay attention to those little small details. So if you have a construction business or something that you aren't using project costing or job costing on, and you're finding that you're losing money, let us know, because we can set those things up for you so you can start analyzing those things better to find out, where am I falling short here? Go ahead to the next slide. So the starting point is listing all the categories used to record your business transactions. This is how we set up a business. Organizing the asset, liability, income, COGS, expense accounts, and they vary according to the industry. So some people might have a lot of individual income accounts, different types of COGS. It just depends on the business itself, but generally there's always going to be those type of accounts in every business: asset, liability, income, COGS, and expenses. So when you set up a business, you want to make sure that you've got everything set up in there that you need to be able to record and be able to analyze your financials correctly at the end of at whatever particular period that you decide on. Go ahead to the next slide. So again, it's going in and looking at your accounting software, and your chart of accounts generally is always going to have some type of cost of goods sold section. There's some very rare, some companies that don't, because they don't really have a cost of goods sold that they track. And a lot of that sometimes is like service provided things, or but it just depends on how things are set up. So everybody can be set up with the cost of goods sold. Just so that everyone here knows, it is not mandatory that you have a cost of goods sold section. It is strongly encouraged, though, that you have that, because everything that you sell or provide is going to have some type of cost associated with it. But it's if you want to record it up in those variable cost or down in the fixed cost is what you have to decide. And that's where we come in and we can help you make the best determination for how you should be doing that. But it's very recommended that you have a cost of goods sold section in your chart of accounts. Go ahead. So in here, it's kind of showing you the different types of accounts and what kind of things are in there. So like I'm working with a company right now that I'm doing some work on, and they are an HVAC company. And so they have a couple different things. So in their cost of goods sold, they like to have their labor for the guys that are doing the work, the payroll taxes that are included in what they pay the guys doing the work, course, any materials involved, any subcontractors that they pay to help do the work, and different things that are associated with doing the work. That credit card fees one is optional. I don't see that much in cost of goods sold, but some people put it there. I usually put it down in fixed. But you just kind of look at those things because those things are all going to fluctuate based on how much income you have. So that's why they're considered cost of goods sold. Then you go down to the expenses part, and those are the things that are going to be more fixed and not related to actually what you bring in. Now, some cases, they might be. Some cases, automobile and truck expenses could be part of your cost of goods sold. So it's really can be very specific with whatever type of company that you have. So we're looking at, though, what do we need? You know, the whole idea of today is what do we need to break even? And setting up the right accounts is really important. So it gives you the gross profit, break even, and then the analysis tools. So I 99 times out of 100, when I'm doing a project for somebody, I'm always revising their chart of accounts on based on how they originally set it up. Very rare that I'm not, to make it so that the reports mean more to them and they can make more sense of what their company's doing. Next slide, please. So here is just an example of how the gross profit is determined. People always say, well, how much money did I make? Well, the cost of goods sold section is used to isolate the cost directly associated, as we talked about, with delivering that product or service. And that's what creates your gross profit. You'd have that number, and then you subtract all the expenses that are outside of those things, which are called your fixed expenses. And then that's where you come down to the bottom and you get your net income. Your net income is your bottom line income. Your gross profit is just what you made on the services you provided or items you sold and the costs associated with that. And the excess of revenue of the direct, I mean, you can see what it says here, but a lot of people get gross profit and net income confused. But you can see the difference and why it's a big difference here. But it helps because when you're analyzing things, a lot of times you're looking at that gross profit number is the first thing you're looking at. Because if that's a negative, then you're really in trouble. Go ahead to the next slide, please. So within here, there's also other income and expenses. And a lot of companies like to show this, and we prefer you show this because it's not usually part of your operations. So we say that anything that is not part of your operations, for example, and the thing they show you here is loss on disposal of a fixed asset. Another example would be other income might be interest that you've earned on, say, a savings account. That's not really part of your business operation. So that's going to go down in other income and expense. There's like one of the other examples I can say is that when everybody had the PPP loans, if they were forgiven, you had to take those into income, but you didn't want to show those as income in your general operation. So it went down in the other income line so that you could see that that was outside of your normal business operations. And then also the CPAs could see that. So they didn't include that in your income on your taxes. But you can have one, I have some people that have one header account for other income and have 5 different sub accounts so they can see each individual one, or they just throw everything into one and look it up later. So that's what that bottom part section is to put any expense or income that is not associated with doing the business itself. Go ahead. So here it is to calculate your break-even point. So you're looking at, and this report can be run, and you can show your percent of income. So right here, this is showing that based the income and the cost of goods sold, that there was a 30% gross profit amount. Okay. But the total expenses were 41% of the total income. So lost money, right? So you've got to look at that and go, okay, what do I need to do? What do I have to do to cover those total expenses? And then you kind of have to look at, okay, it's going to be specific to different people and what type of income they have and what type of cost of goods sold they have. we go to the next slide, please? So the next slide talks about figuring that. So you have your fixed cost, and then you have your unit contribution margin. The unit contribution margin is if you're selling, say you're selling a particular product, and you know that you're selling that product for $150, but your cost on that unit is $75. So $75 per unit is what you're going to have as far as gross profit to cover the rest of your expenses. So that's kind of where you start with going, okay, if I sell this many units at a 50% gross profit, is it going to cover my total expenses? And this is not something that's always easy for some people to do, especially based on whatever their business model is, but you can do it. And in this situation, you know, they had to look at this and go, okay, well, I'm doing 10% negative income here. So I got to figure out, you know, where do I need to be? And is it feasible? Next slide, please. So it's talking about, in this example, the fixed expenses are $242,000. You divide that by the gross profit expressed as a decimal, which is 30%, and that yields your break-even sales. So in order for you to make money on this particular example, you would need to have income of $795,000, not $587, based on your current cost of goods sold percentage and the total expenses. I think it's pretty clear for most, but sometimes you need a little help in trying to figure that number out. But this is just trying to show you that when you're looking at your numbers and you're like, okay, what do I got to do? Well, this is saying they need to generate another $200,000 in income, keep their gross percent, to be able to cover their expenses that they have. Go ahead, next slide, please. Okay, so in here, the income statement recap is showing the percent of income column, in reviewing gross profit percent, and then the net profit percent. And how do these percentages compare with your industry benchmarks? I've had different companies that will ask me, I have no idea how I'm comparing to other companies. I have a roofing company that he's just bombarded, you know, he just blew up. And he's like, Vicki, I need help with understanding where should I be based on other similar businesses, other similar business models, because you don't want to be one completely way ahead of everybody else, because that means you're probably charging a lot more than anybody else, and that might cost you business. But you also don't want to be way below, because that means that you're not charging enough. So these are things that, you know, you want to look at those. And like industry benchmarks, there's different places that you can get those. Some people have what they call like groups, say 20 groups, where you have 20 different business owners, all of the same type of business, that compare information. I was in the car business for about 30 years as a CFO controller, and we had what they call 20 groups and financial analysis groups. And you might have 25 different Toyota dealerships, and everybody's comparing their numbers to see where they're ending up, because if a dealership is making a 50% gross profit and the other one's making 10, well, why are we different? They want to help each other out. But then also I can Google, you know, what's the roofing company benchmark numbers. So it just depends on where you want to get your information from, but you want to have an idea of where you should be. You know, hey, I want to have 30% gross profit. I need to have 30% gross profit to cover my expenses. But again, it takes time for these things. Go ahead and go to the next slide. So here, you know, when you've calculated what you're supposed to do, it'll say, hey, this is I've calculated my break even. I need to do this. Well, can I actually do that? Can I achieve that sales volume? Do I expect any of my fixed expenses to change? Do I need to adjust my salary? These are things you should look at on a very consistent basis, if not at the very least at the end of your year, because, you know, really on top of it, business owners look at it on a monthly basis. But you know, if you aren't even looking at it, I do a year-end review webinar that I've done in the past, and that's something that we suggest you always look at the end of the year is, you know, these questions. Are we going to do better next year? Are we doing okay? And how can we do better next year? And can I actually do this? Or do I need to look at cutting cost? Do I need to look at not taking as big of a salary as I do? How can I get my sales increased? Those are all things that need to be considered when you're trying to break even and make money. Next slide, please. So how can you forecast it? You know, if you expect your numbers to change over the year, you can create a pro forma. A lot of people do this when they're starting to create what we call a pro forma or a budget or projections, is, you know, in the QuickBooks system, it's called budgets. If you create a pro forma budget, you can do it on Excel, kind of, you know, playing with the numbers to see where you need to be. Then we can actually input those into QuickBooks based on your pro forma that you're saying, I got to do this to make this much money. And then those reports can be run to compare what you actually did versus what you're budgeting or estimating, I guess you want to call it. I hate the word budget because it's not really a budget, but it is saying, okay, we're going to do this much. We want to do this much in sales, and this is where our expenses need to be to make money at this bottom line. And then we run those comparison reports and go, okay, where did we fall short? Where did we go over, to make adjustments on a you know, consistent basis. So you're looking at the results as far as, is the sales volume realistic? Again, the same questions. Do I need to cut back on some expenses or salaries, or what do I have to do to increase that volume to get me where I'm going to make money? Next slide, please.
We've got a couple of quick questions for you. First, Marion's
Okay.
asking, what are the benchmarks for the appliance repair industry? Do you know?
No, I don't know off the top of my head. When anyone asks me, it's something that I'm probably going to have to research myself. It's we work with so many different companies. We don't have a standard, you know, thing that we refer to for benchmarks. So I generally will do research to find out, you know, a consistent trend of what benchmarks generally are in that industry.
Gotcha.
Okay.
And then another attendee is asking, if we were to take the total profit of the business and divide it into the total number of technicians / salespeople and evaluate profit from that perspective, we know that each person will yield different numbers, but is that sound logic in determining the profit per employee?
Yeah, I mean, it does depend on a lot of times on how much you pay, but if you can calculate an average of what each employee brings you gross profit wise, yeah, you can look at it that way, because sometimes, like I say, the roofing company I had said they were going to bring another commissioned salesperson in. And how can they sustain that? Well, they know that that commissioned salesperson needs to at least do this much to cover what they're going to pay them. And sometimes it starts off where you're losing money on that person, but you make money. So if you have technicians that, again, I think I talked about earlier, that if you know that that technician can bill out this much as an average for this many hours a week, then that's, you know, you can determine how much income each person's going to bring in. But yes, that's, you know, that is something that can be helpful in determining where your numbers are going to be at. Tracking profit centers, locations. This is another type of thing that when you're looking at the tools within QuickBooks, some people have different departments, different types of income. And we always say, if you're going to have, don't have 25 different centers in your chart of accounts. What you want to have is, you can use what they call profit centers locations, which is classes, and you can have one income account, and then you can code things out to different centers so that you can run reports based on those centers. You can also do the same thing by the type of customer. So that's only in desktop, but you can say, we want to see this customer is a retail customer, this customer is a wholesale customer. And if you go to the next slide, I think it shows you that. It's asking for that. Okay, so as you can see there, they broke out their classes by install, retro, replace, maintenance, and repair. So they can kind of see how they're doing on each of those areas. Are they making money? what's going on in each of those areas, where are they falling short, where are they doing well. But that way you don't have to have three different sales accounts for the HVAC. You break it out by classes. So I can usually look at a person's set of books and tell if this is a better way to go, instead of having a bunch, multiple sale accounts, multiple cost of good, multiple expense accounts, because it just really clutters up your general reporting, and it gets really lengthy. And you want to have your general profit, loss, and balance sheet, you want to have to be very simple to look at, and you can dig deeper from there. Go ahead to the next one.
Patrick's got an additional question. I think this
Okay.
related to the previous slide. He said, but average profit and loss, you have to find out what they must bring in to break even, right?
Yeah. I mean, you have to find out what can a technician bring in versus what you're paying them to determine, what's going to be that break even point. But the break even also is going to include stuff that's down below. It just depends on how you separate out, like, again, your cost of goods sold versus other stuff. So like I say, with technicians, a lot of people will put that up in their cost of goods, the direct labor and things that are associated with the people that are generating or, providing that revenue. You do look at, you are going to look at what each person can do for you when you're kind of figuring a budget. Hey, I have 5 technicians. I think each one should bring in this much income. That's what I'm going to go with my budget for sales. And based on how many hours they work, you kind of estimate, and then you determine, your budgets can be based on, hey, I know I should be paying, 10% labor as part of my sales. And then that's how you figure your budgets for the different cost of goods sold account. It can get, in depth, but once you get it set up and understand it, it's pretty simple. Go ahead to the next slide, because I think we're running out of time. Oh, that was good. Okay, Q&A. So here we are with Q&A. So, if you have more questions, please put them out there so we can take a look and answer those for you. Nobody? Okay. Did you see anything, Jeanette?
I have not, no.
Okay, let's go to the next slide.
Are you touching on the chat ones too?
Yes, I've gotten them all.
Okay,
Yeah.
Patrick just did another one, so I didn't know if you'd gotten that one, sorry.
What was that one?
Yeah, that was the
The P&L.
P&L, you have to find out what they must bring in to break
Oh
even.
yeah, we just got
Yeah.
to.
Okay.
So the benefits with working with us as a company out of the box. Unbiased recommendation software. Obviously, we're Intuit specialist, but it's not that we don't know third-party applications. That a lot of companies have third-party applications that integrate. We are not certified experts on those things, but we work with them a lot. But we work generally with Intuit. We don't work with Sage. We don't work with those type of things. This is what we do. We're Intuit specialists. So we also can provide ongoing product discounts with our volume and what our position in the marketplace with Intuit. They let us provide pass-through discounts to clients that purchase products through us. You get access to all of our personnel everyone has to be certified to work in QuickBooks, and we have different divisions, and it just depends on your need. And our BD people and I can determine generally who you need to work with if you have an issue. Understanding your industry, we work with all industries. So there's very few. When I first started here, I was amazed at how many companies we worked with, but I can't think of anyone that we've never worked with before at this point, because we've worked with, so many different companies over the years. So we also provide individual training, support, and ongoing accounting services. So people that just need help learning, if they need recurring services, if they need a cleanup project, those are all things that we provide to people. And we are very, very, very good at it. So next slide.
Thanks, Vicki. We had a couple more questions come in.
Okay.
So Patrick was asking, with the fluctuating pricing, do we have a way to adjust in a constant question mark? And then he went on to say parts specifically, our cost has much lower margins now.
Mhm.
Um,
You mean adjust your, like your projections or budgets?
I'm gonna see if I can allow him to speak. Hang on.
Yes, he said yes. Yes,
Okay.
once you put in something in there, you can adjust that, yes. Based on fluctuations, and I know that happens on occasion, and sometimes you have to go and say, oh, I gotta adjust my projections for this year based on what we're currently experiencing with, if you used to get a 40% return on the parts sales and now you only get 20, yeah, you gotta adjust those numbers. As a client, are they scheduling meetings monthly? So Doug, to answer your question, it depends on what you require. We actually have one agreement that is it's a 12-month commitment. And you get a discount on the hourly consulting rate. And you get an hour a month at that discounted rate. And then if you go over the hour, then it's still billed in 6-minute increments over that rate, and you pay for that every month. It doesn't carry over, but it provides you, it's at $250 versus $300 an hour for consulting. And that's just based on what you want. Set my alarm. What's it? Yeah. I do have clients that are, religious about that, and want to talk to me once a month and have me look at things and answer questions for them. And so, yeah, it's whatever your particular needs are. Not everybody's the same. And I talk to clients all day, every day. I'm sorry, I'm talking very fast. I talk to clients all day very fast. I talk to clients all day, every day, and everyone has different needs. So we generally talk about your specifics. Patrick, you're giving me a bunch of crap. Come on now.
I love
That's
it.
Patrick. That's truly Patrick. We know he's paying attention then.
Yeah.
That's good. I know. I love it. I do the same thing. So was there any other questions we didn't get?
No, that was it.
Okay. Oh, he's sorry. I can take it, believe me, I dish it out as well. So I appreciate everybody being here today. Hopefully that was very helpful for you. If you are going to need some help, contact us here at Out of the Box, and we'll get you set up with probably an initial, discussion to talk about what your needs might be and see how we can provide, services for you, or, whether it be one time or occasionally or every month. So I work with all the different departments, and we can help you. There's usually nothing that we can't do for you.
Well,
All right.
thank you, Vicky, and thank you, Jeanette, and everyone for joining us today. Vicky's email address is on the screen. If you need to contact her, or at any time, you guys can contact Maggie or myself at administration@unitedservicers.com, and we can get you in touch with Vicky. Thank you
All
very
right.
much, ladies.
Thanks
Thank
for
you,
having
Sarah.
us.
Have a great day. We
right.
appreciate you.
Okay, bye, everybody.
Yep.
Bye.